Welcome to the Innovators and Investors Podcast. I'm Kristian Marquez, founder and CEO of Finstrat Management. At Finstrat, we provide CFO-led accounting, finance, and reporting services to assist clients monetize their business. Stick around to the end of the podcast and I'll share how you can be our next guest. Now on to the show. Hello, and welcome to another episode of the Innovators and Investors Podcast. I'm your host, founder and CEO of Finstrat Management, Kristian Marquez. Super excited because today we have with us Luke Cooper, founding general partner of Latimer Ventures. Luke, welcome to the podcast.
Thanks for having me, man. I'm excited to have this dialogue.
Super excited for our audience to have the benefit, gain your insights, not only as an investor with Latimer, but also as an entrepreneur as well. So with that, let's kick things off. If we could start with investment thesis on Latimer, please.
Yeah, I'll try to my best to answer the question as directly as possible. I mean, one of my traits, I think, as an investor is to be pretty explicit in the approach and some of the assumptions that I've made that support the strategy. A lot of my experiences as a founder really relate to my ability to build a thing and then sell a thing. And it's a skill set that has been derived as a result of being an M&A lawyer for years before that, as well as in-house counsel at State Farm. And all those things led me to a place where I was able to build companies and exit them successfully. And what I learned along the way was that there weren't a lot of entrepreneurs that had that skill set, that understood how to navigate the corporate development schemas of these large companies that make strategic acquisitions, that understood how to work with brokers or bankers, that understood the role of the investment banker per se, how to get to M&A, how to talk about it. All of those things were a black box for most founders. And what I discovered was that after reviewing the data was that companies that had more than one opportunity to either do a Series A properly or to exit the business at the Series A, when they ultimately got to exit, Kristian, they typically got 4 times more in terms of a market multiple on that exit. And so just by building the M&A muscles within a company's DNA prior to and through and after the Series A could lead to very significant outcomes. And so that's really the foundation of the thesis for Latimer Ventures, which I began in 2022. I went out and raised a little bit of capital, and the thesis then has not changed. It was founded on the belief that there are a number of founders, particularly diverse founders, Black founders, Hispanic founders, women founders, who not only lack that information, but they lacked a whole host of networked relationships across the Fortune 500. And if I could bring the nexus of opportunity through those Fortune 500 companies closer to the company while making an investment and then focusing on creating real asset value within the company that could be materialized within a shorter time frame, 3 to 4 years, that we would have a really predictable, consistent model of investing and dispersing returns to investors. And really that has been the focus. And again, in terms of the absolute focus and thesis, it is really around these M&A principles, applying it, but also applying it to a specific category within investing, which is enterprise tech investing. And when we look at that category, again, we're very data-driven in how we approach these things. And when I look at the category, nearly 1.1 trillion has been returned to investors since 2009 by investing in enterprise versus 300 billion on consumer. So we know that enterprise tech investing is really where the action is. It's where the most acquisitions happen. It's where the largest acquisitions happen. And quite frankly, it's where you can solve very knowable problems that have extreme value to the acquiring companies.
A whole bunch to unpack here. And one of the things that I hear is markets of consideration, enterprise being top of mind. But we'll also talk about, I'm hearing themes on founders. And a lot of times my experience has been founders know their product inside out. Generally speaking, they also know their market. And I think that may be open to debate a tiny bit. But I'd love to hear your thoughts, though, when you're receiving pitches from potential portfolio companies. What's the lens through which you look through at these founders?
Yeah, we have a whole set of criteria, Kristian, which you well know. I'm happy that you're our back office and support us in that way. And so we have a whole host of criteria. We're looking at companies that predominantly get to $1 to $2 million of ARR within a reasonable time frame. We care about the customer base, can't be too concentrated. We care about the attachment to the customer. Is this a thing that can just be easily replaced? And is the category growing? All of those things are sort of part of the normal criteria that a lot of VCs at the stage that I invest in think about. But I think the other things that we think about as well are the coachability of the founder, right? Because to get to an outcome, you've got to really be coachable and able to execute on really the brass tacks that comes with M&A, and then also consolidations, or even if you're going to go do an IPO, right? To do an IPO proper, the company needs to have 200 plus million ARR. So to navigate your way from zero, a product idea, to $200 million of ARR, you've got to be tremendously coachable and able to execute on what you get coached on. And then lastly, I'll say that for a lot of these founders, one of the things I look for is, do they know where they are, right? If you have no spatial awareness of like where you are in the journey, it's going to be hard for me to help you navigate that and constantly recalibrate that for you. And from my perspective, startups are in three places only: your product, your scaling, or your optimization or optimizing. And oftentimes in the product phase, you're really trying to find that product market fit. You're trying to find the right go-to-market motions that then will support the company through Series A, Series B, et cetera. But you're not ready to scale. And so oftentimes what I see are founders who are prematurely scaling at the product phase, or prematurely optimizing for things that they just should not be thinking about at such an early phase. And so if you're a founder and I'm working with you and you've got all of those lines crossed, it's going to be very hard to untangle those things. And so we typically look for founders that understand like the game that they're playing and like how to navigate their way to a good outcome.
So what's your yardstick for product market fit?
The yardstick is really, have you gone through a renewal cycle? Because it's one thing to sell into an enterprise, and I've done that when I was building Fixed. We raised $6.5 million for that company, 80 employees, got to a strong exit to Assurant, all cash, no escrow, no holdbacks. And across that 7-year time horizon of building that company, we grew it 300% year over year, acquiring customers like Home Depot, Nike, Stanford University, New York Police Department, all 37,000 police officers having our apps running on them. And so what I learned in that process was it was exciting to get those customers, but it was even more exciting and more of a story to investors to talk about how we were going through renewal cycles with those same customers and the relationship they had to the product that we offered them. To the extent that the customers are crazy about the product, I mean, we want to see that. We love to see that there's a strong renewal path, and that there's a few champions that really are willing to back the product and talk about it when we ask them for customer referrals.
I've heard this theme now of the quality of recurring revenue. And for the benefit of our audience, we dissect ARR, it's new sales plus expansion minus gross.
Sure.
And being able to understand, hey, it's one thing if you got a great sales team and you can continue to close deals. It's another if your clients are turning over, to your point. It sounds like then, for purposes of this transition for product market fit to scale, that you're absolutely taking into consideration the quality of that reoccurring revenue.
Absolutely. Absolutely. It's not just about the revenue itself. And I think that's where my background as an operator really pays dividends, right? Because a lot of investors, they can ask those questions, but then are they asking the right types of questions that lead them to a proper analysis of the quality of that revenue, right? Are they talking about like the value proposition that they were sold on? Are they thinking about the specific titles that particular contract was sold into, right? If you're selling into the CIO stack for the same product, and then you're selling also into the human resources stack, they have very different expectations and selling processes, maybe even different sort of approval processes. And so a lot of those things can be be out of harmony, but you as a founder need to understand that, know that, and we got to be able to talk about how we bring it all into harmony.
And so with that, I mentioned you're an entrepreneur. For benefit of our audience, you've been a successful founder yourself. Can you please share a little bit about that experience and key takeaways that carried over to today?
Yeah, I think the short of it is that I started my career as an M&A lawyer and built two companies over the 15-year period that I took to exits by Fortune 300s. The first one was a cybersecurity company, and I jumped in way late, about a year into its founding, but I became a third co-founder of that business. The two founders were incredible, but they just didn't know how to navigate their way to strategic M&A and scaled operations. And so I jumped in and started helping, facilitating most of those things. and then identified multiple buyers, worked with the buyers over the course of a year and a half, 2 years. And then we got to a great outcome. We sold that company in a two-part transaction, first for 3 million and then 55 million for the whole thing. It wound up being a 27x outcome. And I made my first $500,000. And I was like, wow, this is incredible. I was in my late 20s and I just thought that making money out of nothing, an idea that proved valuable to khaki, right? Which was at the time was a $5 billion defense contract. They're probably 10 billion now today, and they're publicly traded. I just thought that was amazing. And so I wanted to do that again and again. I was fortunate to have a bankruptcy in between, right? So a company I basically bought out of bankruptcy. I found it was a distressed turnaround opportunity. I just got my timing wrong. I closed the deal in middle of summer of 2008. And then obviously the fall of 2008, the economic crisis made it very difficult to access debt, which was my whole plan for turning around the business. And it was a great deal. I sold off the manufacturing assets to finance the deal. I thought I was really smart in how I structured it, but I hadn't thought about like the prevailing market conditions and other things that could affect this business. And so I think it's a skill that's important for founders as well, to learn how to not just build a thing, but how do you gracefully deprecate a thing and kill it. And I went through that process with that company. I licked my wounds. I thought very difficult. I thought very diligently about the kinds of businesses that my background spoke to and that I could be successful in. And I started Fixed in 2013. We started as an insurance claims management system and quickly evolved into mobility APIs that supported mobile device repair, replacement, a whole host of things. The idea really came from me dropping my bus on the phone, my phone on the bus in Boulder, Colorado, and witnessing the reaction of all the people around me. From there, we raised over $6.5 million. Grew the company 300% year over year. And toward the end of that experience, we started to run out of capital. We were way underfunded. The $6.5 million, the category had maybe 7 or 8 total players. And we were maybe the second company to build something in that space. And the 5 competitors that I had raised 475 million collectively to my 6.5. So I was outmatched, but I knew I could compete, and enterprise was where we competed. No one could really touch us in that space. We had great growth, but we're running out of cash. And so in late 2019, I made the decision to just fly to Vegas on a one-way trip for Consumer Electronics Showcase, CES, which was I think January or early February. And I flew out there with no plan. I was just like, I'm just going to go talk to the major sort of CEOs and leaders of the companies that I've already had some kind of established relationship with. I snuck into the Assurant VIP reception at the Caesar Hotel. It's probably 1,000 people there, but I was ready. I was prepared. I beelined my way to Alan Colberg, who was the CEO of Assurant. And I began to talk about culture, that the culture that we were building. I began to talk about the product. I began to talk about the markets that we were in. At the time, US Cellular was one of our largest investors. They had put $1 million into the company, and they were one of our biggest customers. And I knew that Assurant had lost them as a customer. So I said, hey, we could be a vehicle for you to recapture that business. And it was just a great conversation. They saw the potential. Fast forward 30 days later, we were under LOI to be acquired, and we closed the deal in 6 months. At that time, we closed on August 17th, which happened to be my daughter's birthday, August 17th, 2020. And at the time, the stock price was for Assurant, Fortune 300 was trading at about $90 a share. And over the course of the next 7 months, we really just worked on the integration and expansion of the product through their markets, right? Obviously, they've $10 billion company. They've got incredible reach and relationship, particularly through the carriers, right? Like T-Mobile. And we expanded the product. And by the time I left, the stock price was at $130 a share. And so that little acquisition and some of the work that we did, obviously alongside of all the other great things that Assurant is and continues to do, created $3 billion of market cap, right? And it's one of the great stories that I talk to corporates that I want to work with about, because from tiny acorns, you can grow mighty oaks.
Your situational awareness is fantastic. That's an incredible story. And I don't know how many founders would get on a plane who are thinking about, I'm going to get into this conference and I'm going to find this person and I'm going to tell them why they're going to do this. That's great. And I think also your credit too, I don't know if I've heard now Nelson Mandela gets credit for saying, win or learn, I never lose, but it's true. It seems to be a hallmark of founders that it's not all ups. There's going to be downs. But as long as you can learn from your experience and incorporate it into what you're doing today, you're at an advantage. Because I've heard no shortage of stories from very successful founders that mirror yours, that it's about persistence and determination. And so let's talk about that. So now there's a whole host of portfolio companies within Latimer. You have the benefit of working with some great companies. For those founders who are looking to scale, and think about the big picture. How do you encourage them to walk this line between, hey, you really need to be dialed into your distribution so you can increase your top line, but you also have to put in business processes that will enable you to eventually sell your company because people are going to take you seriously.
Yeah, I think a lot of it, and I want to go back to one of the comments you made about not a lot of founders might hop on a plane. I think the reality though is, Kristian, all of them would hop on a plane and do exactly what I did. The difference is they wouldn't know what to say, right, to drive the deal. And I think that's where I'm most helpful to founders who are at these critical points of intersection in their company. To your question, really, what people buy are not necessarily just the strength and quality of the product, right? What I try to instill in the founders that I work with in the portfolio today, we've got 5 portfolio companies. We've deployed almost $5 million, and we're a small fund. We're going to be around the journey to go raise fund 2 pretty soon. But with the 5 companies that we have in the portfolio today, I have a direct line of communication with the founders and a lot of their leadership teams. And what I try to impart on them is that people don't buy a cool technology just because it's cool. They're buying a process. They're buying your go-to-market motion that might allow you to get customers more predictably and reliably in a small local maximum kind of world that they can then take and apply to their larger mousetrap and access thousands, millions of customers and users, whoever. And how do you do that? I think you do it by building advanced sales playbooks. You start by just writing things down, right? By talking about who you're talking to, identifying who you're talking to. If you're talking to the manager of IT and that's the main person you're selling into, that should be in a playbook somewhere. And then like really refining that process over time by using what I call an experimentation framework. Because a lot of founders will just like jump at things. We're very opportunistic at times. And that can be distracting and take your eye off the ball, even if you wind up hitting a home run out of one of the things that you pursue. And so what I try to get them to do is follow this experimentation framework that allows them to take a very big idea and condense it to a very small experiment that is well defined, right, before you actually do it. And so if you don't hit the target, you either scrap it or you do some analysis as to why you didn't hit the target and you move on, right? And this is a method that allows the founders to just stay focused on the main thing while they're slowly incrementing their way, breadcrumbing their way to another thing, right? Which might be a second product or a different variation of the first product.
So your comments are timely because arguably we're at an inflection point, some may argue a bubble, with the introduction and production of AI. I've seen a lot of companies raise money at higher multiples than their SaaS counterparts, a lot of it on promise of the founders and what the tech is intended to do. So how are you navigating that, knowing that process is important to you and it's a key essential part to eventually seeing a material exit?
Discipline, right? Like that's the only word that comes to mind, the main word that comes to mind. Discipline, particularly when it comes to pricing. We're not going to go chase the hot deal that everybody's a part of and is 20 times forward revenue, right? Like, those are not the deals that we want to chase. Maybe there's a world in which, the Sequoias and the Andreessen Horowitzes, where that is a reasonable path to take, particularly when you've got a multiple billion-dollar fund. But I think for the normal VCs like myself, we're looking for companies where, quite frankly, it might just be undervalued, right? One of the companies that we invested in, we were fortunate to get in that company at an $18 million valuation because we saw it before other people did. And yeah, there's some hairs there. It's a little bit challenging in terms of coaching up the management team, but it's beginning to work. And I'm seeing some proof points. We just closed the Series A almost at 3 times. And the company has recently signed a $49 million contract. And so maybe there are scenarios where you can make a lot of money by investing in and chasing the things that everybody else is. But I think my spider senses tell me to pursue the things that other people might not be looking at. And look, it follows the same trend of investing in Black founders. Like, Black founders are historically overlooked. But when you really study the category, 1 in 3 Black founders who are focused on enterprise tech is getting to Series A, right? The gross number for everybody is 1 in 15, right? So they're beating the market by a factor of 5, right? And so I think those kinds of statistics are interesting and lead me to a deeper observation and oftentimes a better investment than other folks.
Discipline's a great answer, because not being a VC myself, my sense is that there can be pressure from your LPs as to pursuing the next hot thing. But sometimes it just takes the ability to say no, or maybe let me take a look, but definitely not oh sure, let me jump on this just so that I look good. Luke, this is a great podcast. Before we wrap up, would love to hear your thoughts on the landscape ahead for the venture capital market.
Yeah, I think venture in the future is going to look a lot more like private equity. I believe that the markets are getting smarter, and these multiples that we've paid in the past, particularly in the 2010s, are not gonna hold water going forward. People are going to really care about like the operational efficiency and financial performance of the underlying companies. And you also see it bearing true in corporate America. The corp dev teams of the Fortune 1000 they're growing them, right? They're not shrinking them. So it speaks to more M&A, but more people analyzing and thinking more deeply about the pricing, right? Because you're getting rid of brokers and bankers in the middle of that too. And so I think that in the future, we're well positioned, because think about opportunities in the venture space with a M&A lens. And I think that's going to work out well for us.
Brilliant. Love it. Luke, if there are any founders, co-investors, limited partners that want to get a hold of you, how can they find you?
You can find me on LinkedIn, Luke Cooper, and happy to connect.
Fantastic.
Awesome.
And that's another episode of the Innovators and Investors Podcast. Again, our guest, Luke Cooper, founding manager and partner of Latimer Ventures. Luke, thank you very much for being on the podcast. It's a great show.
You got it. Thank you.
Kristian Marquez here. Thank you so much for listening to the Innovators and Investors Podcast. If you're a successful founder or an investor who would like to be on the podcast, please visit podcast.finstratmgmt.com/podcast-guest. If you've got something out of this interview, please share this episode on social media. If you know someone that would be a great guest, please tag them on social media to let them know about the show and include the hashtag Innovators and Investors. I'd love to see your posts and suggestions. We're regularly putting out new episodes and content. To make sure you catch each new episode, please subscribe to the Innovators and Investors Podcast. And your thumbs up, ratings, and reviews go a long way to help promote the show, and it means a lot to me and my team. Would you like to know more? Go to our website, finstratmgmt.com, or follow us on LinkedIn or on X. Our handle is @finstratmgmt. This is Kristian Marquez. Thank you for listening. Until next time.